Hi, I'm Mike Richter, and today we're going to be talking about picking your source of funds and the pre-approval process for traditional mortgages. So for an overview, today we're going to be talking about cash. That's if you happen to have the full purchase price for a purchase you're looking to make in real estate. We're also going to be talking about private financing and owner financing, some of the advantages and disadvantages associated with that. We're also going to talk about traditional financing and some key elements to look for, as well as different kinds of financing programs. And finally, in the traditional financing vein, we're going to talk about the pre-approval process. Let's get started. So cash is by far the easiest way to purchase real estate if you happen to have the cash available to do it. Makes sense, right? You don't have to worry about going to a bank or borrowing money from anybody. You have it available to use. Problem with that is it takes already having the full purchase price plus some to make that purchase. And not all of us have that available to us. But you still should know when you get to that point what some of the advantages and disadvantages are to doing it. Well, some of the advantages are there is no interest. There's no mortgage. It makes sense. There's no bank. There's no loan associated with it. So one of the inherent advantages to it is if you've got vacancy, you're not worrying about how am I going to make the mortgage and keep possession of this house. Instead, you're willing to go ahead and find better quality tenants, and you're able to ride out a lot of the storms that some of your fellow investors that are leveraged to the hilt might not be able to handle because they probably did not plan nearly as well as you have for this process. So some of the disadvantages associated with cash is there's no leverage, right? If you've got $100,000 and you're buying a $100,000 house, well, you can only buy that one house. Whereas if you were to use leverage, you might put $25,000 down on a house that's worth $100,000 and carry a mortgage for $75,000, and then you still have $75,000 available just in case something comes around. Also, something important about leverage is leverage used right can increase your return on investment. Now, one of the coolest things about leveraging that's not using cash is that you have cash available for quick things that you get available to you. Like a great deal pops up, you're more able to be reactive to that, as opposed to if you had put all your cash into one house, it's going to take you a little bit to refinance out some of that money to action on something. So you're going to have less agility with your deals if you put all cash into your house. So let's take a look at private investment and owner financing. So for private investment, you need to have pre-existing relationships to get somebody to be willing to lend you money for the purchase of real estate. And in the case of owner financing, well, you need to find somebody, one, that either has their house completely paid off and is willing to allow you to go ahead and pay them in installments for a period of time, or they need to have a loan balance low enough that your down payment can pay off their loan balance, and they have to still be willing to accept payments from you over time. The cool thing about both of these arrangements is they're fully negotiable. That means as long as you can come up with a win-win, something that meets the objectives of both sides, you can come up with some amazing creative deals that can help you out a lot and can help them out a lot. Because maybe they're just looking for a fixed income and don't want to deal with the hassle of tenants. Well, if you were to take the property and they were to be the lender, well, they would get regular monthly payments and they don't have the headache of the tenants. You do, because you're the one purchasing the property. Now, one quick note on owner financing is, in general, you probably want to stay away from owner financing offered by other investors. And the reason why is usually they're targeting demographics that cannot qualify for regular mortgages. So they're wanting a higher percentage of interest to offset that risk that they're dealing with. Now, bottom line is you want to make sure that in private investment and owner financing that you are doing your due diligence to make sure that the deal is going to work based on what kind of terms you can come to. For example, if a private investor is willing to lend you money for 6 months, well, that may or may not work for you. It may work because you're looking just to flip it really quickly and you know that the market is going to be able to deal with that. That might be a good option for you. But if you're looking to hold the property for 5 to 7 years, that may not be the best option for you, because in that 6-month period of time, you may not be able to get the refinance that you need to pay off your private investor. But it comes down to knowing your exit strategy and what your lending needs actually are. So let's move on to traditional financing. So 2 programs are specific to owner-occupied properties. That's the FHA, that's Family Housing Administration loan, and the VA loan. That's the Veterans Affairs loan, and that's for veterans that have been honorably discharged from active duty, members that are currently serving on active duty, and members who have served 6 years or longer as guardsmen or reservists. Now, to get specific guidelines as to who qualifies for a VA loan, you may want to look at the VA website. You could simply Google Veterans Affairs Home Loans or VA loans, and you will get all of the qualification criteria. Now, when you're looking at traditional financing, you're going to want to look at what kind of terms are you hoping to achieve in traditional financing. Are you looking for a fixed rate loan? Maybe a loan that's fixed for a period of time but adjusts after that? Or maybe you're looking for something more like a balloon payment, something that has a low entry rate for interest, but then after, say, 5 years, you need to be able to either refinance the loan or pay it off in its entirety. There are different circumstances where each of those kinds of terms are advantageous to you. But my suggestion is to go with 30-year fixed rate for property that you're looking to have as an investment. And the reason why is it provides maximum flexibility to you. Now, you're going to pay a slightly higher interest rate associated with that flexibility, but that cost is worthwhile when you're looking at the ability to minimize your mortgage payments on lean times and pay higher mortgage payments on times where you're able to make those extra payments and it's comfortable and makes sense for you to do that. Whereas on a 20-year or a 15-year mortgage, well, guess what? You're having to pay those mortgages off faster, so it costs more money every month to make the payment on that. Now, there are some rare circumstances where you're going to have a 20-year mortgage cost the same amount as a 30-year mortgage in terms of principal and interest. Usually that doesn't happen, but sometimes it can happen. And if that's the case, you may as well just go with a 20-year option, just because you're going to pay the property off 10 years faster and it doesn't cost you any more, or maybe the amount it does cost is insignificant enough that it's worthwhile for you to do that to pay it off in 10 years faster. Now, you also want to know what your down payment options are. Typically for owner-occupied properties, you're going to have many more down payment options than you would with simply a set and forget investment properties. For example, the VA loan, you can have a 0% down payment on the VA loan. Totally possible. Though I would not suggest doing that unless you're getting a discount where you're going to have instant equity in the property, even with 0% down. With the FHA, if you've got good enough credit, you can get into the home with as little as 3.5% down. And that's a really good deal for those that aren't able to get the VA loan. And finally, there's conventional loans, where you can get in for as little as 5% down, which I've done a time or two. But if you put less than 20% down on a conventional loan, you're going to deal with something called private mortgage insurance. So you're going to want to know what you're getting into before you decide on the loan type and the kinds of terms you're looking at. So now that we talked a little bit about traditional financing in general, let's talk about the pre-approval process that you're going to go through to get a bank to be willing to loan you money. So step one is proof of income. The bank wants to know that you're able to pay the mortgage every month. Now, this is usually going to take the form of pay stubs and things of that nature. But if you have significant bonuses that add to your income that you depend upon to make the payment on the mortgage, you're going to want to make sure that you have good documentation on that. I'll tell you a little bit about my situation. Now, back when I was active duty, I had a skill set that I would get a bonus for every month, and so it worked like clockwork. And I'd been receiving it for well over 6 years, and it was all in my tax returns, so it was very well documented. And for the foreseeable future at that point in time, I would still be collecting that bonus. So I made sure that my loan officer had all of that documentation up front. That way, later on in the underwriting process, there would be no question, oh, where is this income coming from? And it would make it a lot easier to sell the case that I can pay the loan back, because that's basically what this whole pre-approval process is for, is are you able to pay the loan off? The second step of the pre-approval process is a look at your assets. This is where you provide 2 to 3 months bank statements of every single checking and savings account that you have, as well as the mortgage statements associated with any other real estate that you have, and statements for any investment you have, like stocks, bonds, mutual funds, as well as any retirement funds you have available, or any funds you have in your control that you could possibly use to make this a more sure deal for the bank. So for example, I've got a couple of accounts in the children's names, but I have that money at my disposal if an emergency were to arise, and then I would go ahead and put it back after the fact. So I count that as assets for the purposes of a pre-approval process. Now, step 3 is a credit check. This is where they pull your credit, and now most mortgage companies are going to go with your middle credit score. There are 3 credit reporting agencies, and each of them typically will have a very different credit score on you, so they'll go with whatever is the one that's in the middle, usually. And for the purposes of a mortgage, a 620 credit score is considered good. Most lending institutions will give you a mortgage with a credit score of 620. Now, if you have a credit score of 740 or above, that's usually considered great credit, and that'll put you in the higher tiers of better interest and having to pay fewer points to get good interest rates on your mortgages. And that's just a fact of life, that if you have a higher credit score, it's looked as you have a lower risk of not paying your obligations. So they reward you for that better credit score by having a lower interest rate that they have you pay on your loans. Step 4 is employment verification. This is where you're going to need documents and provide references as far as who is your employer, who is your spouse's employer if both of you are going to be on the mortgage. And you're going to want to make sure that someone knows that you're going to be providing that information to a bank, so that when a bank calls you your work and calls your boss or your HR department, there's no surprises. If for whatever reason throughout this pre-approval process you're not approved, don't think that's the end of the world for you. the fact of the matter is sometimes the standard pre-approval process will not take into account specific circumstances which make you a less risky buyer than somebody in similar circumstances. So if you can write a good letter to somebody of influence in that lending institution to let them know why they should reconsider approving your mortgage and kind of showing them exceptional circumstances that make you a better credit risk than the automated process might have caught. And if nothing else, you can always shop around. That's a very important piece of this puzzle, is if you're shopping around and your credit is being pulled in several locations, that's not a huge deal if you're doing it in a short period of time, because there's this understanding that, yes, there is going to be some shopping around for financing. Now, another cool thing about the pre-approval process is if you have an established relationship with a lending institution and with a loan officer, it's usually much easier to get subsequent pre-approvals. So, for example, I've done 13 mortgages with my loan officer, so we have a very close relationship. And anytime I need a pre-approval letter, usually based on my great track record with her, I could just go ahead and give her a call and say, hey, can I get a pre-approval letter for this amount if for whatever reason the seller is thinking that I'm unable to come up with the funds, or if I were in a seller's market, then I would want to make sure I had that pre-approval up front just because it would make my offer much stronger than somebody that only had a pre-qualification. So relationships, super awesome to have. When you have a good loan officer and they get used to the deals that you're doing, it ends up working out very well, and you get access to a lot of different underwriting guidelines faster than other people would get them, just because if a new program is out and you're a good customer and that new product could be helpful to you, it's in your best interest and the loan officer's best interest to make sure that you have the information available to you, because you might take advantage of it, and that is a win-win for both of you. The loan officer gets another commission or gets good marks on their record if their salary, and you get another tool in your tool belt to work with in real estate investing. So we talked about a lot of things today. We talked about cash and how it's very powerful for making good offers at a discount because you're able to act quickly. We also talked about the fact that cash's main advantage is that there is no mortgage, right? So you don't have to deal with interest piling up on you. You don't have to worry about whether or not you're able to make a mortgage payment because there is no mortgage. So you're able to do more due diligence on the vetting of tenants so that you're better equipped to have good tenants. You're able to wait patiently for that. We also talked about the fact that there is an opportunity cost associated with using cash to purchase real estate, in that if a great deal comes by and you need to act quickly, well, you may not be able to refinance the cash out of that property fast enough to act on the deal based on the needs of the seller. We also talked briefly about private financing and owner financing, where the beauty of both of them is that they're fully negotiable, and that you want to make sure that the terms that you can agree upon are going to work with your investment strategy and your exit strategy long term. And I also wanted to re-emphasize a note that owner financing from investors is typically not a good thing, because usually they're looking for higher interest rates because they're looking to serve people that cannot get traditional mortgages. Speaking of traditional mortgages, we also talked about that. We talked about three main brands of mortgages, being the FHA, Family Housing Administration mortgages. We talked about the VA home loan, and we also talked about conventional financing. And in that, we also talked about different terms like, are you going to have a 30-year, a 20-year, or a 15-year mortgage? We also talked briefly about whether you're looking for a fixed full term mortgage, an adjustable rate mortgage, or a balloon mortgage. And I gave my recommendation that for investment properties, I typically go with 30-year fixed unless there's a reason to go 20-year. I've got 2 of my properties on 20-year mortgages, and the reason why is when I refinanced them at the time, the 20-year mortgage payment cost less than what I had been paying on a 30-year mortgage, and I was able to shave 8 years and 7 years off of those 2 mortgages respectively. And we also talked about the pre-approval process, the 5 steps, and how even though you may be turned down for an approval, there are possibilities of getting a second opinion if your case merits it. Maybe there are some things that the automated process did not account for. And we also talked about getting a second opinion. And we talked briefly about how having personal relationships in the real estate business is very powerful, especially when it comes to getting financing. When they know that you can perform, it's really easy to get second and third mortgages down the road. So, if you found great value in this video, please feel free to give it a thumbs up. If you've got any questions, put them in the comment section down below. And if you'd like more of this kind of content, by all means, go ahead and subscribe. Thank you so much for your time. Have a fantastic day.